Those with variable mortgages are once again waking up to news that their payments are going up. The Bank of Canada announced this morning that the key interest rate is going up another 25 basis points. That sets the new target at 4.5%, the highest it's been since 2007. Joining us this morning with more is Peter Cischecki from Everything Financial. Good morning, Peter.
Good morning.
Your take on the announcement, not unexpected.
Worst kept secret since the Bruce Boudreau firing here in Vancouver the other day. It was expected. This is the area, give or take a little bit, but the number that they were targeting since last March. The question is, how long was it going to take to get here? What were going to be the increments? But the messaging all along has been pretty consistent that this is the area we were going for, and now we get to see coming forward in the next few months what the true effect on inflation is.
So this is the 8th consecutive hike. Do you think this is it for a while then?
Based on last month's messaging, yes, but we'll have to see what the notes are today to see for sure and then decipher that and go, okay, what is the message and see? Because we did get a good drop in inflation last month, and these 8 hikes, as you've pointed out, they haven't even affected inflation yet. That's not really going to start to happen until April or May, which is, 13, 14 months from the first hike last March. So we really haven't seen that effect yet.
Okay, so it's speculated that this could be the last interest rate hike for a while in the cycle, as they call it. So what could prompt the interest rates to go back up again in a different cycle? What perfect storm?
More or worse storm, as a case may be, really. More inflation to a degree that it is back to where it was, like those high 6s, those low 7 numbers. But there's that other R word we talk about, that recession word.
Right.
The recession, if that does happen and it starts to occur more so than what is already here, then that usually is an indication of rates coming down, because you have to help the economy, spur on the spending. And how do you do that? Put more money in people's pockets. And the balance is what's the problem is. It's very hard to get that right balance between lowering rates, increasing rates, inflation, and everything else that goes with it.
Yeah, it's a little bit of a game. Put it into perspective, though, this recent hike included. What does that mean for people's mortgages?
Variable mortgages, another quarter point, here we go. But long-term mortgages, those rates have been coming down. They've come down, depending which bank, but 3/4 of a point to a point in the last month. So the 5-year rate is now the same as the 3-year rate. The 1- and 2-year rates, the banks have bumped them up recently because that's where everyone was going. So if you need to bridge the gap.
What does that mean, bridge the gap?
If your mortgage is up for renewal right now and you go, what do I do? Look at 3-year, and realistically, if you look at the economic factors, you're going to probably be paying a little more in that 3rd year if rates truly do what we think they're going to do and start having a steep decline later in 2023 and into 2024. But a 3-year rate can get you over the hump until we get lower rates come ahead.
Okay, Peter Cischecki, Everything Financial. Yeah, a lot of people wanted some information this morning, and hopefully they got some information from you. Thanks, Peter, for joining us.